Hello and welcome to State of the Economy. Year 2016 has brought with it huge challenges on the economic front. There's a chill in the global economy, deflationary pressures coming from, new deflationary pressures coming from China. Many economists are even talking about a possible recession in 2016. Watchers of global economy and big investors like George Soros have spoken about the possibility of a mild recession in 2016, and India will not be insulated if something like that were to happen. And to discuss that and much more, we have with us in our studio Dr. Shankar Acharya, who has been the Chief Economic Advisor to three governments actually. The Congress government in the 90s under Manmohan Singh as Finance Minister, subsequently the United Front government and the NDA. So he's worked for four Prime Ministers and three Finance Ministers. So you can't get a better man to talk about the economy. Welcome to our show, Dr. Shankar Acharya.
Thank you, Venu.
Now, you are still very active. You are on the Monetary Policy Committee of the RBI. You watch the economy. You write a column in the Business Standard where you give your observations on the economy. And you have been writing for a while, predicting some of the headwinds that the Indian economy as well as the global economy are facing today. Now, just give us an idea as to what is new that has happened in 2016, the way the Chinese markets have crashed, the way everybody's talking about new deflationary pressures coming on to India and other emerging markets from China, oil prices meanwhile going down even further, disrupting commodities as an asset class, commodity prices. So what exactly is going on, Dr. Shankar Acharya?
Well, I'm not sure, Venu, I can tell you what exactly is going on. I can only give you my sense of what's going on. And well, I think it's not that 2016 everything has suddenly come out of the blue. Various things were going on earlier, and those trends have carried on and in some cases perhaps strengthened. For example, you mentioned some of these things. The crash in the oil price, which really started in the middle of 2014 calendar year. But people are expecting that it wouldn't go as low and perhaps not stay as low for so long.
Which is why there was an expectation that if it stops at $50, India would benefit. But now at 30, 28, nobody thinks anybody would benefit.
Well, I have my quarrel with that, but I'll come back to that. Then you take another one, the Chinese slowdown. Now, really, if you look at the graph of Chinese growth,
already happening.
It's been happening for the last 5 years, or 4 years at least. And the real slowdown, I would say, had really set in certainly by 2014 and 2015. It's Chinese official data recently published say it's going to be 6.8, 6.9. A lot of observers say no, really, it's somewhere between 3 and 5%. But obviously, I don't know better than that. And the third thing which has happened, which is continuing, but which really sprang a surprise, I think, during 2015, is really the enormous refugee crisis in Europe, migrant, refugee, whatever you wish to call it, because of the breakdown of state order in major countries of the Middle East and so forth. There are some other things, but I think the confluence of these powerful trends has suddenly kind of ratcheted up uncertainty in the global economy. So I think the big difference between
the market is responding very sharply now.
With uncertainty. I mean, big difference, I think, between a year ago, say January last, is not so much the trends, which were already sort of visible, maybe not the refugee migrant trend, but the other things were there. But I think the degree of how deep and strong they were and the uncertainty levels, I think,
much higher today.
So, I mean, even now, official kind of so-called multilateral official institutions like the World Bank and IMF are still predicting global growth at 3.5%. I mean, you have to just look at their recent publications.
But 2015 we had 2.5% growth, right?
But I mean, remember one thing, for various reasons.
So would you agree with the World Bank?
No, I mean, the World Bank IMF projections of, let's be clear. World Bank is saying 3, IMF saying 3.5.
A bit optimistic?
I think they are. I mean, I think there's always a lag in the way the documents get produced. And so I would say that if we do 2.5% for the globe, world as a whole, that would be pretty good. But I think there are good chances that might drop below. Normally, global recession is defined as when global growth is below 2%.
Below 2%, yeah, right.
And now, my view, I don't think we'll be there.
But we'll be close to that.
We'll be close to that, and I can't rule out going below 2%. But if you ask me to bet, I'd say 70% chance or 80% chance, a little bit higher than 2%.
Okay. Here, I must tell you, Shankar, The Economist has carried a small article where they have done research to show that since 1999, on 200 occasions with several countries, of course, the IMF predicted a much higher growth the following year, but there was a recession the following year. They could not see it. 200 times they went wrong.
How can they be in so few years 200 times?
No, the countries.
Countries.
Yeah, so the number of countries.
Right. Got it.
Yeah. So a total of 200 recessions happened rapidly after a year of decent growth. Next year recession. The article says that IMF could not predict a single one. So I'm just sort of reinforcing the fact that it's so difficult to.
It is.
Now tell me. So are we? So how do you look at India in this context? I'll tell you where I'm coming from. The finance minister was at Davos. There were other Indian industrialists, bankers, etc. Uday Kotak of Kotak Mahindra Bank, he argues that businesses today, Indian businesses, do not have the same confidence level that they had in 2008 when recession happened. They were much more confident then of riding the storm. The other thing he says is that Indian banks also, the banking system is also not as robust or as confident of riding the storm as it did 2008. How do you see this?
Well, on that particular point, I think I agree with that broad view, and there are good reasons for that. Remember, in 2008, we were at the tail end of the most fantastic 5-year economic boom that India has ever seen.
Yeah, sure.
Where we averaged close to 9% growth. And our macro...
It was the golden period of economic growth.
I call it the halcyon years. And the macro kind of things, whether you looked at current account deficit, fiscal deficit, investment levels, all these things were terrific and better than any other time, any sequential 5-year period ever in independent India. So, I mean, naturally, corporate entities, businesses, people everywhere in India were feeling confident, and they thought, well, chalo, we'll ride this out. And also one should remember that we actually did ride it out for about 2-3 years.
Yeah, we had, in fact, 10% growth in 2010-11.
1 year it kind of, yes. And some of that was because we continued with bad policy in the medium term.
The stimulus,
The stimulus.
There was a global consensus for stimulus.
But
then the consensus turned.
But also our stimulus was the nature of massive subsidies and things like that.
Sure.
And which were not easy to withdraw, or the earlier pay commission.
Sure. But we have another pay commission on our hands.
Well, that will also create some problems.
So
I mean, I think that on just to touch on where I feel India is today. First of all, relative to other countries, other large economies, we are still doing better. Certainly if you compare us, for example, to the other BRICS.
Because they are in recession.
Well, I mean, Brazil is in recession, Russia is in recession, China has obviously slowed down by its standards very sharply, and South Africa also is teetering on recession. So the only one last man standing in
It's a bit like saying compared to the Hungary, we are getting some food.
Well, yeah, but I mean, that's not a bad thing. So that's, one should not, So I think whereas our underlying growth, I doubt that it's very hard to know what underlying growth is until it's past you. But I think it's in the neighborhood of 6%.
Okay.
Well, maybe it'll be as measured by the CSO's new methodology, it may be closer to 7. But in terms of what it feels like.
I think what Raghuram Rajan says, the feel on the ground.
The feel on the ground, or the weathermen say, what will be the chill factor. I think it'll be closer to somewhere between 5.5, 6 at present. Now, what it'll be during the year as a whole, we'll have to wait and see how these uncertainties work out. I think the two biggest uncertainties, and they're related, are China, as to how sharply it's slowing down in the coming year, the year we just started.
And how quickly commodity prices recover.
And the related oil and other commodity prices. Obviously, if the Chinese is more the George Soros hard landing scenario, then things are going to be bad for the global economy in a harder way.
In fact, George Soros says that they've already hard landed.
Well, they haven't landed.
He said he's observing the hard landing. He's not predicting a hard landing.
Okay. Well, yeah. I mean, but I think that's where I think the weight of opinion, and I don't think can do better than what others think, is still that, look, China's slowdown is a serious process or event for the global economy, but in terms of real growth, it's quite possible that when 2016 has ended, China will have contributed more to global growth than any other single country, including the United States. And this is simply arithmetic. Because even if China grows at 5%,
they would still be contributing 30-40% to global growth, right?
Exactly. So I mean,
so their relevance
really,
remains.
Yeah, it's really if China goes below 5% to 3 or something like that, that we are sort of into a different scenario, closer to global recession, in my view.
Okay.
Now, so as I say, I don't think that's still the likely scenario, but it can't be ruled out. Now, obviously, what happens to India will relate to some extent to what's happening out there, because though we are more closed than many economies, we are still much more open than we were a quarter of a century ago. So I think on oil, you said, maybe we are being hit too hard now that oil prices has dropped
because
around
oil
30.
is also an asset class. It has created wealth destruction.
No, but that's true, but not in India, I don't think.
Not in India, among exporters of oil.
No, of course. No, but that, you're right, absolutely right. But I mean, I think the commodity, the terms of trade gain to India has been massive so far. Some of it's gone to government in the form of higher excise taxes, lower subsidies, etc. And it's probably half and half to government, half to consumers and producer consumers, if you see what I mean. So that's, I mean, if it got reversed with the same speed that it's come down, we would be flat on our backs. Be very clear on that. So what has happened, of course, for the global economy is that probably there was a sweet spot or a sweet range somewhere between $40 and $60 per
about
barrel.
$50, they say is a sweet spot.
Yeah, somewhere. I mean, it's probably a range always. And below 40, there's too much damage being done in things like the energy industry in major countries, including the Gulf and the US and Brazil.
I'm told
and
US
Russia.
private investment worth $200 billion a year on oil industry.
Yeah, could be. But I mean, you have to still remember that, I mean, those absolute numbers look large, but as a ratio to total investment in the US, they're still well below 5%. But, these things have a linkage effect. There are many banks which have lent in the US and other money centers to major oil majors globally for large projects and so on. Now, as oil firms look sick, which they are looking sick quite a lot, not just shale, but more generally, some of those loans are looking pretty sick too. So, there is a related effect. And of course, in those countries of the Gulf, Saudi Arabia and all the Gulf countries and so on, which had become significant players in the world trade because of their economic clout, when the oil price drops from 110 to 30, they are in a difficult situation as purchasers of commodities from the rest of the world.
Yeah, sure.
And that's where we are hurting. I mean,
I read somewhere that 35% of our total exports go to these resource rich or resource exporting nations.
Exactly. So. And also one thing which people are not yet commenting on, but I see as pain ahead for us too, is the impact on our remittance flows. Because those typically happen with a lag. Because, the people who are working in these countries don't get sent back overnight. It happens with all takes time and so on.
So it could have impact the BOP situation.
And so I think if I were in government, I would be not only worried about, what's 2016 going to be, but I'd be thinking quite hard about how am I going to manage 2017 and 2018 when commodity prices start going up? On the other hand, I'm feeling the after effects of the decline in commodity prices through things like remittances on our external finances. And apparently our exports are nowhere. They're 15% down.
True, absolutely.
Yeah.
Tell me, Shankar, now coming back to one very critical aspect of our recovery in 2016, if at all, is what Finance Minister Jaitley talked about in Davos, where he said that the health of the banking sector is very critical. Varying numbers are being speculated upon. Some say that stressed assets in the Indian banking system is today probably in the range of 15 to 20%. Assets suffering various levels of stress. And Raghuram Rajan has been saying, central bank governor is saying that we must at least tell the truth, at least provide for bad assets, at least show them in the balance sheet, so that the truth is known, and then you move to clean up the. Now, how do you see the banking sector? Raghuram Rajan also said that some 10, 15 big corporate borrowers who are also whose loans are not doing very well in terms of repayment of interest. There are some 8-9 lakh crores locked up, especially infrastructure investments, etc. Commodity companies, and because of that, banks are not able to lend to other small borrowers, right? So there is a kind of logjam there, How do you
I think that's true.
See that playing out?
But I would like to point out a couple of things. One, this is again not a new thing. This has been building for a while. I mean, essentially what happened is...
But it's got aggravated because of this further slowing of the economy.
Of course.
Last year, everybody said, including Finance Minister, his advisors, that as the prices recover, they thought that these bad loans or these bad assets will automatically become good assets.
No, there was that hope, I agree. But I just want to point out that really what happened during the boom years, up to 2008, when everybody was feeling wonderfully happy and corporates were both investing a lot as well, but they were also borrowing quite a lot. And that's where I think the quality of the kind of decisions made, obviously, in the exuberance was not uniformly good. And this illusion of high growth, well, also reality, continued because of stimulus and other things for another 2-3 years. And so, in a sense, you really began to discover the underlying problem around, I would say, somewhere around 2012, 2013. And since then, one has known. I mean, I think there were reports, I recall a major report by Credit Suisse, for example, on the Indian banking system.
Yeah, the Credit Suisse report which came out a few months ago.
Yeah, but then this one came out 2 years before, so they were revisiting that issue, I think. Pointed out to these issues that Indian corporates were highly leveraged on the one hand, and there was no quick fix readily available. And I regret to say that situation is still very much there. If anything, you're right, there was a hope that a lot of the sort of blocked projects would get going, the economy as a whole would turn up. And if that had happened, you would have seen a kind of unwinding of some of this stressed asset problem. But I think 2 or 3 things happened. One, of course, is, as you know, there was bad luck in terms of two things mainly. One, the rural economy. We had a second drought in succession.
That also the finance minister is referred to.
So the rural income demand kind of flattened off.
Tapered off.
Secondly, these factors of China and oil, while not absent earlier, they've been there since 2014, kind of got a grip on the world economy which was not quite anticipated. And I think, therefore, it's much harder. And nobody really, I mean, this export slowdown which has occurred, I think our export in value terms have grown in the last 13 months at an average of about 15% in dollar terms. And I don't recall such a bad story on exports for so long in the last 30 years. So I think that...
In fact, somebody said it's, since 1952 is the worst export performance since 1952.
I can well believe that. I haven't checked back that long, but I can well believe that. So all of these, after all, exporters also borrow. So all of, and by the way, a lot of our exporters are small and medium.
Exactly, yeah.
You know, so they also are feeling the stress of if you're not being able to sell, it's hard for you to pay back, whether it's interest or repayments. So I think that is a real problem, and this is coming on the back of a structural problem, which no government so far has had the courage
so
to
there's a macro
grapple.
problem which has got further aggravated, and then there's a on-ground micro problem with the banking system.
Yeah, but that banking system problem, to some extent, is man-made in the sense of we've been aware that there are governance issues with public sector banks for at least 20 years. Okay, it's not new, but no government has been able to grasp the nettle of reforming the public sector banks in a serious way. Statements get made, some tinkering gets done, but ultimately we know every few years they have to be recapitalized.
Tell me, Shankar, I remember when you were chief economic advisor, when Yashwant Sinha was the finance minister under NDA, in one budget there was a proposal that fresh capital in banks should come from the outside public and others, and the government public sector character may be retained, government stake can come down to 33% by getting fresh capital from outside.
Yeah, that you're absolutely right, Venu, and that was not just a budget statement.
But at that time, I think
we actually had a bill in Parliament.
But it was not supported by the BJP at that time, is it?
I mean, basically, the bill was tabled in Parliament, so to that extent it was supported. This was, I think, in 99 or thereabouts, 1999, which had these characteristics. But basically, you see, under current law.
So what I'm saying is that there was a solution then.
And under current law, public sector ownership or government ownership of public sector banks cannot fall below 51%.
So you had an amendment to the law.
And so the amendment that was being proposed by Mr. Sinha and the government of the day was that there should be the minimum should drop to 33%, while retaining the public sector character of the bank.
Exactly, I still remember.
Whatever that means. So it was that was kind of left vague, and it was not just a budget speech para, because a lot of budget speech paras get ignored later politically, but this actually got into Parliament as a bill that was tabled.
But finally didn't go through.
It did not find enough support.
In fact, so in a sense, what Yashwant Sinha did then, all that needs to be done is for his son and Mr. Jaitley to just pick up that and implement it.
But at the same time, please be aware.
Because today, there's a crisis because banks need, I'm told, 1,80,000 crore of fresh capital over a 5-year period. So in that sense, that problem is right staring at you with equal intensity even today, isn't it?
Yeah, no, absolutely. But what you have to remember is that what the banks today need, I mean, that argument for reducing the minimum share required and saying that you have to go to market was to wean the banks away from the government. But I mean, today you have a recapitalization problem which has to come from somewhere.
And today, Shankar, today all public sector banks who are listed on the stock exchange, their market value of their shares, I'm told, is lower than the HDFC's market capitalization. It is that bad.
No, that's right, and that includes. I think the actual exact numbers are, as I saw reported.
So this is basically telling us that the market does not believe the public sector banks' bad loans, the quantum of bad loans that they're declaring.
That's one reason, and secondly, I guess the market puts a discount because of the governance issues in.
So what do you think should the budget do about this? Since Mr. Jaitley has talked about this as a key problem, this and rural demand. These two he mentioned at Davos that these are key problems. What do you think the budget can do on this?
I don't know that the budget itself the budget itself can do much more than essentially provide more capital like it did in the last budget. I think they provided 25,000 crores. I don't know how much they'll provide, but they will provide. So I think that's...
They have a roadmap, 25,000, 10,000, 10,000.
Whatever, Ayush or whatever it's called, that thing. No, Indranush or something.
Indradhanush,
Indradhanush, so that's one. I am not sure that politically they are ready to grasp the nettle of essentially doing what Mr. Sinha tried to do. That is the elder Mr. Sinha. Because my reading of this BJP government is that they're not so far they have not actually shown much keenness for privatization per se.
Okay.
You know, after all, Mr. Jaitley's last budget had talked about strategic disinvestment of about 20,000 crores worth, but not a single transaction has occurred during the year. So I'm not sure that they have the political.
They have the stomach to do it.
They have the political stomach, desire, whatever you want to call it, to actually say, look, we are going to reduce government capital in the banks in terms of ownership, and so I think they'll have to basically find ways. They may before the year is out, but I don't think the budget will do it.
So essentially what you're saying is that it might be business as usual going forward on some of these issues. Reforms are not really, the government is,
I think
at
what
some
they
level,
can
lost the will to implement reforms.
Well, I think,
lost about 15 months.
Yeah, but hang on. I don't want to sound completely negative at all, because I think I am reasonably confident. I've written about this, that circumstances and their own determination will get the GST through.
Okay.
During this coming the year that we've entered, and I think if they do it, if they succeed in doing it, and if they do it in a reasonably correct way, right way, that is a big thing.
That's a big thing. Yeah.
I mean, it's not that suddenly GDP will jump by 2%. But it's one of those structural.
That's
reforms.
a medium-term thing. Take a while.
Well, it's a structural reform which has to be started.
Yeah, sure.
Just as banking may be also a structural reform which is difficult to start, this one I think will happen.
Okay.
So I think I mean I may be wrong.
So let's
see.
Yeah, let's hope they get some of these things right and minimize the damage that's coming from the world over.
Yeah.
Thanks a lot, Dr. Shankar Acharya, for talking to us. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.